Thanks very much, Sean. And yes, the U.S. job market seems to be continuing at a healthy pace of growth. Last month, total payrolls are now back to their pre-recession levels as they were in 2008. So 217,000 new jobs were created in May. Most of them were in the private sector. And this is the fourth straight month of gains above 200,000. Longest streak in 14 years. However, unemployment stayed the same at 6.3% after dipping in April. But labor force participation remains at a more than 30-year low as Americans struggle to find full-time jobs. Still, economists on the whole are optimistic, but they say there is still a lot of work to be done. Now, the latest U.S. jobs data helped Wall Street continue its winning streak. The Dow and the S&P 500 reached new records again. The S&P is now flirting with the 2000 level, and investors bought stocks that tend to do well when the economy is rebounding, like energy and industrial shares. And the market's upward momentum may continue. The index that measures fear or volatility in Wall Street, the VIX index, fell today. The NASDAQ also closing up 0.6% for the day. All right, we're now joined by David Dietze, President and Chief Investment Strategist at Point View Wealth Management, to get his take on the markets, jobs, the economy, and everything in between. Good to have you on the show again, David.
Thank you.
So we have pre-recession job levels. That's the good news. Unemployment stuck at 6.3%. That's the bad news. What do you make of today's report overall?
It was almost a Goldilocks report because on the one hand, with over 200,000 jobs created, with no uptick in the unemployment rate, the concern about perhaps slipping into a recession after that ugly Q1 GDP report is kind of off the table. On the other hand, because that labor participation rate is so low, because when you add in the part-time workers to the full-time unemployed, it's just not satisfactory. The Fed's going to continue to be
David,
accommodative.
you've mentioned two things I want to hit on. Firstly, the labor participation rate, 62.8%. That's the lowest in about 30 years. So basically, people are just not getting into the job market. What does that tell us?
Well, it certainly indicates a lot of people just dropped out. They've given up. Now, obviously, there's some demographic shifts too, but on balance, it shows that it is not the type of job market which is bringing people off the sidelines. It's not an exciting economy at this point. Therefore, there has interest rates and good for stocks.
Hit on the Fed, another thing that we discussed, that you mentioned briefly, the GDP down 1%. How do you reconcile that with the government, the Obama administration, saying, hey, the economy's making a turnaround, the jobs numbers are improving, but yet we had a negative GDP quarter? How does that all work then?
Well, on the face of it, extremely disappointing. But when you drill down and say, well, what was the weakness in the economy due to? There was an inventory buildup. And often what we see is when there's an inventory buildup, it reverses course quickly the next quarter. On top of that, of course, we did have some rough winter weather. And finally, we have seen some data points on manufacturing in the service sector, which shows some better health snap back in April and May. So I think that's the reason the equity investors are still on board here.
Is today's jobs number allaying concerns of a second quarter of negative growth? Do you think that's helping, or we just not have enough information in yet?
No, I definitely think it's helping because we now have about 5 months in a row of over 200,000 per month average job growth, which is better than last year. So it suggests a trend in the right direction. Subpar growth, yes, but still growth.
Okay, what about the outlook for the jobs market, considering some of the legislation changes we may be seeing with all this talk about raising minimum wage? How is that impacting the sentiment?
Well,
I see you're chuckling there.
Yeah, well, certainly when you raise the price of anything, you're going to get less demand for it. So I think it's hard to make the case that a higher minimum wage is going to help the unemployment situation. It may be helpful for other reasons, but certainly not to get that unemployment rate down.
All right, now you mentioned the Fed before. What do you see Janet Yellen and the rest of the Fed doing now with this jobs number that we've got?
They've got a plan of a slow tapering of their bond purchase program. That should end in October, and then after a considerable period, they'll finally start to crank up the federal funds rates. I don't see the report today as changing that plan. So at least right now, I think investors can take heart that the plan that's been laid out will continue to be the most likely plan. There's some predictability.
So keeping interest rates where they are and maintaining the QE tapering at the same rate.
Yeah, I think that's right.
The market's very optimistic today. Overall, they've been relatively resilient. What's your outlook?
Well, what was really interesting is how not only stocks did well today, but actually bond yields came down. So I think the key factor this week was the decision by Mario Draghi, the European Central Bank, to do some very novel monetary stimulus.
Right.
So you've got a 1.3% on the 10-year Treasury and the 10-year German bond. The money's continuing to flow in here.
Let's simplify that a little bit. So European Central Bank saying that they're going to have negative interest rates. What does that mean for the U.S. economy and for the global economy? How is that helping?
Well, it's going to motivate European institutions to do something more creative than just keeping their money at the European Central Bank. They're going to make loans.
Right.
And some of those loans, I think, are going to find themselves going into the U.S. market. And I think that's going to provide a healthy backdrop to stocks going forward.
Now, you mentioned that bonds did well today. How would you allocate your funds right now in terms of percentages, markets, commodities, stocks, bonds? What would be the best play?
Well, we certainly like the earnings yield on stocks relative to fixed income. The problem, however, is that earnings yield is down. Valuations are up, so we're just a little nervous right now. And of course, we're at all-time highs. At any point, there could be a sell-off, there could be a correction. So we think a balance tilted towards stocks probably makes the most sense for the average investor.
All right, great advice. Great to have you on the show as always. David Dietze, President and Chief Investment Strategist at Point View Wealth Management.